Prior to the financially instigated Great Recession of 2008 and 2009, financial stocks of all sorts, but also financial stocks like Aflac in the life and health insurance industry, despite being A-rated with moderate amounts of debt to capital, these stocks used to trade at PE ratios above the normal 15 PE ratio that is historically calculated for intrinsic value. But since that time, as you can clearly see, over the last 15 plus years, Mr. Market has reset the valuation on these stocks, and they've traded at very low multiples. Aflac, for example, is traded at 10.36 times earnings since that time. Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer tool. And today I'm bringing you my video I call 5 Cheap Financial Stocks in the Life and Health Insurance Sector. And they're all A-rated companies, and they all have good dividend growth records, at least over the last decade or so. So I'm going to go through these, and I'm going to announce the ones that I like the best. But before I do that, I'm also going to point out that I actually like each of these 5 companies, and I've used them in portfolios in the past, and I wouldn't be afraid to use them in the future. And they come in kind of different flavors here. So, I'll go over that with you very quickly. This would be the portfolio review of these companies. The 5 names I'm going to be covering are Aflac, MetLife, Manulife Financial, Principal Financial Group, and the Prudential. I want you to notice that they are all A- or A-rated or better. So I do consider them all very high-quality companies. They also all have very reasonable debt-to-equity ratios, so they've got good, healthy balance sheets, and they're all really good cash flow generators. But I'll be talking about that as I go through this presentation. The key thing here is I'm going to look at these in order of dividend yield, and I'm going to go from lowest to highest. Now, the lowest dividend yielding stock in this group is Aflac. And we'll go ahead and put Aflac back up on the board here for you. And I'm going to go back to the adjusted operating earnings that I featured in the intro. And what I want you to, again, want to really make sure you note, the stock used to trade at premium PEs. This 15 PE ratio would be a normally calculated fair value for a company like Aflac, regardless of the sector, that was growing earnings at between 9 and 10% a year, which Aflac has averaged 9.78%. Since that time, the market has really, put a discount. They've reset the valuation, and we now get to the point where the market has been putting 10 multiples. Now, there are 2 ways to look at this, and I think it's very important. One is that you can use the new 10 times earnings as the new normal, if you will, and I really hate that word because reality is things change, but they usually revert back to true normal, not the new normal. But anyway, having said that, that gives you some upside. There is a time when these stocks could be moving back into what I would call normal valuation levels. But until that time, it makes more sense maybe to look at them or look at Aflac, and specifically in this case as a 10 multiple company. So when you look at that, you can see that any time the stock traded below 10 times earnings, which is this blue line on the graph, that it became a really good buy. COVID even brought it down to where the multiples got into the 5 and 6 range. But note that they don't stay there very long. And these turned out to be really excellent times to be investing in the stock. Aflac currently offers a dividend yield of 2.88%, just under 3%. It's A- rated and has 20.86% debt to capital, good, strong balance sheets. Now, when you look at each of these companies here, I do want you to notice when I look at different metrics here that when I'm looking at dividend growth stocks, I'm looking at this cash flow cover the dividend. I'll even take the price off of the graph and anything price related, and I'm looking for the cash flows per share, which are these numbers up here, of $6 a share, $7.46 a share. We are expecting the cash flow to go down this year and then level out, but they're paying a dividend of $1.32 and expected to go up to about $1.60. So bottom line is the dividend is extremely well covered. Now, when I look at this from the lens of other metrics, the other metric I want to look at are sales, because when I put price to sales on here, the normal price to sales has been about 1.3. It's currently trading at a price to sales of about 1.76. All right, so that would indicate it's, slightly more expensive than it should be based on sales, but yet it's got a well-protected dividend. It's trading at a reasonably low valuation, but Aflac would probably be my least favorite amongst this, particular group of stocks. The next company that I want to look at would be Met with a 3.1% dividend yield. So let's go ahead and go into MetLife and look at MetLife from the standpoint of operating cash flow. Once again, I've got operating cash flows that really well cover the dividend. And my payout ratio for operating cash flows, as I point to this thing, is, really about 11 or 12%. So they've got a lot of dividend coverage with the amount of cash flows they generate. From an adjusted operating earnings per share basis, which is now where I'm going to bring price in, you go back to that, where you have this normal, price used to be relatively high. With, in the last, 16 years or so, 17 years, we've reset down to approximately 10 times earnings. 9.84 is what it actually calculates out to be. MetLife offers a dividend yield of 3.15%. It's A- rated, has 24% debt to capital. And once again, if I look at this one from a standpoint of price to sales, I'm seeing it trading a little above the price to sales that I would be comfortable with. I really prefer to buy this when it was really cheap, like low price to sales ratios. The next stock that I'm going to look at in this group is going to be Manulife Financial. All right, now Manulife Financial has a little more dividend yield than what we've seen. It's yielding about 4.95%, actually has the highest in this group, or amongst the highest. Great dividend coverage by operating cash flows. When I look at it from the standpoint of adjusted operating earnings, this one was trading at these, normal multiples, like I said, and then the financial debacle really hurt them a lot. So if I shorten this time frame to something post that time frame, I start getting, better numbers. I got about an 8.5% growth rate. It usually trades at about 10.8 times earnings. That's a, relatively low multiple, where you can buy it today at a blended PE of roughly 7 times earnings yield of over 14%. And once again, as I go through this and look at some of the important metrics, and I look at operating cash flow, it really covers the dividend like a blanket, if you will. So, that makes it look very attractive to me. The next company I want to look at would be Principal Financial Group, PFG. And when I go into Principal Financial Group, once again, I want you to notice that if I look at it from a long-term point of view, this was a stock that always traded at a very premium valuation. It went through the financial debacle actually pretty well. It did have a slight dividend cut. But if you look at it for the last 16 or 17 years, the company's been growing around 5% a year, normally trading at about 10.7 or roughly that 10 to 12 times earnings range that I've talked about. And it's very attractive from the standpoint it offers a 3.86% dividend yield. It's A- rated and has 25% debt to capital. The next company that I want to look at now in this list will be Prudential. All right, so we'll go into the Prudential Life and take a quick look at it. I'm using the new version of Fast Graph. You'll notice I'm a little slow. Now here, based on price to sales, Prudential looks like it has the most attractive price to sales. And there's something important about that I want to add. When I'm looking at all these different metrics here, like adjusted operating earnings and so on, Prudential's been trading recently at about 9 times earnings, 8.94 to be precise. It's trading right now at about a 7.45 times blended PE. It's, again, A-rated, 27% debt to capital. So, we're looking at a company that does offer a dividend yield of 4.88%, and it looks, undervalued today, or at least fairly valued, because the market, as I pointed out, has been keeping these stocks very cheap. So I'm going to go through these now in alphabetical order, if you will, and to go back through them. And I'm going to go look at forecasting a little bit and talk about what I think are the best opportunities. So I'm going to go into the forecasting graph, looking at Aflac and applying a 15 multiple. This would be my aggressive case. If Aflac did grow at a very modest rate, in other words, a negative earnings growth this year, followed by about 3.7% the following year, followed by 6%, we could end up with a 20.84% annualized rate of return. Based on its normal multiple now, it's been reset at 10.75 or 10, we call it just under 11 times earnings. we'd be looking at about a 7% annualized rate return with a 2.88% dividend yield. Now, moving on, if I go into my next selection here and look at MetLife at a 15 multiple would give us a very attractive 16.76% rate of return, but at its new reset multiple, it would give us about 13.1. Does offer us a 3.15% dividend yield and is A- rated. So, it does look attractive and even has a slight margin of safety, but again, also expected to have a down year this year. Moving on to Manulife Financial, here we have one of the lower valuations, a blended PE of 7, a normal valuation about a 45%, potential annualized rate of return for the next couple of years. But even at its normal PE of only 9 times earnings, it would still offer a 24.56, and it offers the highest dividend yield of 4.95%. Currently, it's A-rated and only has 18% debt to capital. So, obviously there are obvious reasons why I like Manulife. Going on to Principal Financial Group, it's growing earnings about 6.5% or so, has a dividend yield of 3.86% prior to today's prices. We'll see what they do today. And I know these stocks, as well as the whole market, has been taking a bloodbath. Trading at 9.89 times earnings at its normally reasonable valuation that it historically has commanded, that would give it a 29, almost 30% annualized rate of return. But even with its new normal multiple, about 11 times earnings, it would still give us 15.21%. with a nice 3.87% dividend yield. So I think that, makes it look very, very attractive. The next stock we're going to look at here is Prudential. Prudential is expected to have a down year this year, but at 15 times earnings, that would give you, a very attractive 35, almost 36% rate of return. However, at its normal multiple, it'd be about 10.6%. So all of these stocks are buy. I do consider these valuations to be extremely low. Looking at these high-quality A-rated financials with very little debt. And Prudential, of course, is the rock. It's one of the leading names out there. So there are the 5 stocks that, I told you that are inexpensive life and health insurance company financials. Next, what I'd like to do is go and look at their performance record with you. And what I want to do with the performance record is point out that, these stocks are not outperforming the market, although Prudential has come very close on a capital appreciation point of view. But I want to remind you, I consider the market overvalued today, and I consider these financial stocks undervalued. So the market has an unfair valuation, optimism here compared to these other stocks. In other words, you're measuring an undervalued stock unfairly against an overvalued market. But from a dividend point of view, which all of these stocks I'd be recommending as dividend growth stocks, their dividend growth rate, over the long run has been very, very attractive. If I, keep it that's at that 16 years, Prudential's grown their dividend at 18% average, 17.27 compound average, and clearly they've generated this is based on a $10,000 one-time investment, roughly twice or a little more than twice the amount of income the market has. And I think it's a lot safer from a standpoint of quality and valuation, et cetera, than the overall market is right now currently. Moving on, if I'm just going in reverse order here, go to Principal Financial Group. It's grown dividends by about 14% for the last 13 years. It's paid more dividend income than the market. And again, being undervalued relative to overvalued, it's got still giving you a nice double-digit rate of return here. So Principal looks good with dividend growth rates of 13.89 and 14% respectively. Moving on, go to Manulife Financial. Manulife has not grown their dividend quite as fast as these others have. It has generated less income than the market over these last 13 years, but I do want to make sure you understand where that came from. That came from the fact that this company did suffer during the financial crisis. If I shorten that time frame to where, it recovered after the financial crisis and then cover the performance here, the dividend's grown at about 6.5 or 7%, and they did produce over these years, this 9-year period of time, more dividend income than the market, but they underperformed it on capital appreciation. But once again, the stock is undervalued here. But I do want to emphasize this gives you the reason or the a rationale behind what I say all the time about the fast graphs as a tool to think with. You analyze different periods of time. You don't just look at one picture of the graph and just make decisions based on that. You use it, it's a tool to think with. The next one is MetLife. Over this short period of time, they've grown their dividend by 13%. They've outperformed the market slightly on terms of income, underperformed it on the things. But again, keep in mind, the stock is very inexpensive here. If I look at it over that 16-year period I talked about, they have a disadvantage to the market on all aspects. So this is something to keep in mind. These are out-of-favor value stocks with good dividend growth records. But again, if you look at them from the standpoint of the historical point of view, the stock has grown to 7.27%, and it's really highly undervalued here. So moving on, the next one I would go to would be Aflac, and last but not least, Aflac has grown about 6.81%. If I look at the performance of Aflac over this period of time, I would see that they produced slightly less income than the market and quite a bit of capital appreciation deficit here compared to the market. But again, they're undervalued and the market is overvalued. But for a 3% dividend yield, buying it today, you'd be buying a higher yield than you could get for the market. When all is said and done here, it comes down to which of these stocks would I pick. And, if I'm looking at it practically, I think, Prudential's a good choice. I think Principal Financial Group is my favorite choice. And it's, trading at one of the lower valuations. But I do want to be clear that if you're looking for dividend growth, it would depend on, your own objectives and some of the things you looked at. Look at it from all the different ways that I did. It comes down to these are all solid investments. And now, I've been asked many, many times here recently by subscribers to our channel here to go ahead and look at financial stocks. So, I want to be clear that I will be talking about different kind of financial stocks in some forthcoming videos. Here I've covered the life and health insurance industry, but almost all financials in the market, because of what happened since that great recession that we had, where they used to be trading at, normal multiples for a normal company. Today they're trading less. Anyway, it's been Chuck Carnevale saying thanks for watching. I hope you enjoyed this video on financials, life and health insurance companies specifically. These are 5 of my favorites. I think they offer the best valuation, the best quality, and certainly all of them offer attractive dividend yields, even Aflac at just under 3%, up to almost 5%. So they're good-looking dividend stocks. Do your own research, as always. I'm just introducing you to here on a cursory view what companies I think would be worthy of spending your time to research. If you like the video, give me a like, ring the bell, join the channel if you haven't joined it already, and also take a look at maybe looking more closely into fast graphs. It's rapidly improving. I used a new version here once again. We'll be launching this version in about 6 to 8 weeks, I think, from now. We're testing it and running it. You can see it's working pretty well. Still a couple of features that we haven't got functioning correctly yet, but we will, and we'll be launching it when we do. Anyway, thanks for watching. I appreciate all of you, and I hope you enjoyed the video. Thanks.